Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking Inghams, ASX code ING. G'day, Elio.
Yeah, g'day, Phil. I sincerely hope the listeners out there will find this interesting. I mean, I found it interesting, particularly given what happened recently and how that has impacted price. So the ultimate question is there an opportunity in this business? But of course, as with all companies, there's pros and there's cons, and I'm sure we'll talk about them in the podcast.
But first of all, let's talk about the congratulations for your gold medal award from the Investor Newsletter Group as the best performing stock newsletter tip sheet. What are we saying here?
Look, actually, we spend our working life trying to convince everyone that we're not a tip sheet, and then, hey, presto, we get a gold medal, which is, gold star, whatever the case may be. And look, congratulations to the entire team, both locally and overseas, for the work that they put in order to deliver that. But I do want to remind investors that Stockopedia is a tool, it's not a tip sheet. So notwithstanding that we've done so well in regards to tips, ultimately our goal and objective is about servicing the entire investment community, no matter how they want to go about picking their stocks, be it either looking at the hardcore fundamentals or looking at the squiggly lines. We don't really care. Ultimately, we want to give them good information. And I think the gold star that you referred to is pretty much testimony to that point, that ultimately we do deliver insights to our members. We assist them in a whole range of different areas, particularly in regards to the very difficult task of picking the right business. And ultimately, when they do that and it suits their personal objective and the way they want to roll, then we continue to deliver that information in a way that should be easy to understand for anyone. And of course, we're here to help them every step of the way. So thanks very much, Bill. But I like to think it more validates our broader strategy in regards to just giving the good information to people that they need to hear.
Okay, well, let's move on to Inghams. And the first piece of news that's been affecting the price recently is the bird flu outbreak. Tell us what's going on there.
Look, this is a multi-level discussion that I suppose we're having here. I suppose the one that we're all dreading and particularly scared of is a strain that is H5N1. And we heard reports that a young Indian chap actually brought it back into the country. He's now being cured, of course. It's actually quite rare to see human transmission of the virus. That's why it's generally called the bird flu. But nonetheless, that's obviously what we're particularly concerned about. However, keen watchers of stock prices would have noticed that Ingham actually had a very significant fall on the day. Now, this particular reason was not because of that Indian chap, but rather it was a case here in Victoria, in a place called Marinated, actually, whereby they discovered a strain, the H7N7 strain of the bird flu. Of course, when you hear bird flu, that's not a good thing. It generally means mass killings of the poultry in order to try to contain it to that particular region. Now, of course, we are in the lucky country, Phil, which generally means that our agricultural sector is quite sparse. There's literally hundreds of thousands of acres in between each particular facility. So therefore, Ingham were forced to come onto the market and actually say that, one, that they viewed the risk as low because of this tyranny of distance, and two, that they actually had none of their broiler farms located in that Meredith region in Victoria, which, of course, let's not forget, I mean, we're talking about 250 plus nationwide. So this is by no means a small operation in regards to Inghams, but it was good to see that. And we saw the stock pass some losses, notwithstanding the big fall on the day. And it comes to the core point. It's a stock we've talked about with members for some time, that this is one of those classic price takers. And as listeners of this podcast over the journey may have learned, they're trying to take all the steps they can to no longer be that, where they can control a lot more of their destiny. And I'm sure we'll cover that in today's discussion as well. So, look, when you hear the word bird flu, you can immediately make a linkage to a stock like an Inghams, as it were, because obviously the fate of what happens there is intimately linked, hence why the company had to come out so quick and make the statement. And the other advantage we have than, say, our friends in Europe, for example, is that there is generally a significant distance issue here in Australia with regards to where our broiler farms are located, and therefore the spread of any disease is generally pretty well contained fairly quickly. It doesn't mean we're immune. It's definitely a risk we've got to be aware of, but it can be contained.
When you say price taker, does that mean that they're subject to the prices offered by the major supermarkets?
Yeah, that's a key part of it. I mean, it goes back to their story, really. And Inghams is probably the largest listed provider of chicken, as it were, or poultry related products, be it either protein, et cetera, to the Australian market. There is also Steggles. I'm sure that'll be another brand listeners will be familiar with, but they are privately owned, so they're not listed on the share market, as it were. Inghams has a long history. I mean, I think it's well over 100 years old. I think it's was formed in 1918. So we're talking about a company that's definitely got pedigree. Although that said, it was sold to private equity about a decade or so ago, and then ultimately was listed on the market, carrying quite a bit of debt. And I think that's something investors got to consider. Again, we'll talk about that in a moment. But nonetheless, once it became that, a price taker meant that it is subject to the market. So if, for example, all of Australia becomes a vegetarian, as it were, then that would have a disastrous impact on Ingham's business, given the fact that they deal with meats and proteins, as it were, that come from natural meats. And if no one wants chicken anymore, then that's going to see the price of chicken plummet because there's no demand for it. There'll be a lot of supply, and that's going to hurt someone like an Inghams, as it were. So look, they are subject to market forces somewhat, but I think we got some comfort in the company's latest half-year result that the volumes for protein-based meats are still quite strong. I think they actually grew some 2.2% in the latest half compared to the same time last year. So there is an underlying demand for the commodity, and notwithstanding the fact that it is subject to market forces, which means that it is more of that price taker, as a business, it's actually quite sound and doing quite good things at the moment. But again, there's those risks, as that bird flu case highlighted, that investors need to be aware of when they're in a price taker like this, because some of the factors that impact them are beyond their control.
So tell us about that recent half-yearly report. What did it look like?
Obviously, I'm going to look at this business from a Stockopedia perspective, because ultimately that is how we inform our members in regards to how it looks. And that means we look at numbers on a trailing 12-month basis. Now, this means that, yes, we consider the latest half year, but then we take the last 6 months of last year in order to create a relative measure that we can use for comparative purposes. And in this instance, it all looked quite good. I mean, at the half-year result, the company's revenues continued to grow. Their earnings per share that they reported and normalised after one-off items was also looking quite good. And it trades on a forecast PE, Phil, of 11.3 times. And this includes the big price decline that investors would have actually noticed. Further to that, in the half-year result, the other thing that was quite pleasing was that margins were quite good. I talked about volumes. They have been increasing in recent times, so that was also a plus. And patient investors have also received the benefit of a pretty strong dividend to be paid to investors. I think it was an interim dividend of some 12 cents per share, which was actually growth on that dividend that they paid a little bit earlier. It has had a bit of history, though, in regards to it's had a bit of a tumultuous past, be it either, we had COVID, of course, we had dodgy CEOs who their remuneration package was knocked back. And I mentioned that debt that the company's been carrying, but obviously as part of their commentary in this latest half-year result, and pretty much everything in the lead up to that, including their previous annual, they've been talking about how the business has been restructured, how it's been reformed, and how they're now focused on growth. And they're looking to definitely do all the right things, provided, of course, it doesn't flood in New South Wales or Queensland like it has done in recent times. There has been impacts to their pricing. I mean, you talk about that price taker phenomenon, Phil. I mean, we just don't have to look too far back to recall the commencement of the Ukraine-Russia war. Now, that had a big impact in regards to the cost of raw feed. Unfortunately, we might not think it's a big thing, but in terms of growing poultry, it is because, of course, you need to feed your chickens in order to grow them to ultimately command a price on the market. So when the price of that commodity goes up, that reduces their margins. And the good news, or the pleasing thing, has been that in recent times, the cost of feed has been coming down, and therefore that has been supporting its price and supporting the business and supporting its margins. And as any investor will know, margins are the great profit expander. So you grow margins, then ultimately, if you increase sales, your profits will grow by more. So ultimately, look, it's had its checkered history. It's tried to put a lot of that behind it, and I think it has. It's got some pretty strong partners. I mean, it's mentioned upteenth amount of times that partners like, your Woolworths, your KFC, Coles, of course, McDonald's, you got Aldi, Metcash, all the big retailers, as it were, plus all the big food chains. So there really isn't much of a place where you can't really find an Inghams somewhere. I mean, at the end of the day, with the exception of a few frozen products that you can get from New Zealand, everything's got to be grown and made here in Australia. And hence that oligopoly sentiment that I was discussing earlier, that if you want chicken, there really aren't many places to go. And hence why the company's been doing well, because not only been turning around their business, but underlying demand still remains strong, particularly for a protein meat, which is relatively cheap compared to beef, for example. And we know the problems that Australian ag have had in recent times.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. A few episodes ago, we had Jessica Amir on the podcast, and she was talking about Inghams and the Ingham story. And what she mentioned, that the land that they produce their chicken from, they're actually future-proofing their business by buying that land rather than having to pay rent. Is this something that you've seen as part of their balance sheet? And maybe that's why the balance sheet is not as strong as what it could be?
Look, that is part A. Yes, that is true. I mean, future-proofing a business like Inghams is critical because ultimately, as a price taker, it doesn't want to be subject purely to market forces. Yes, it'll definitely take them as a benefit when they do come around. But ultimately, if they do nothing but effectively run a fancy conveyor belt, then that really puts their general business at risk. And therefore, increasing their actual real asset presence within Australia is definitely one of the key factors that they're seeing as a potential growth story for them, because, of course, property values only go up, or so they tell me, even though I disagree. But anyway, there's a whole range of reasons as to why they're doing that. But insulating their earnings, I think, is a big point. But the other thing, Phil, I mentioned that private equity. This is a company that was floated in 2016 onto market. And we need to remember that, generally, without wanting to sound too facetious, many of these vehicles are often heavily laden in debt. And look, there's three sources of funding that investors need to be aware of. One is their back pocket, as it were. So that's retained earnings, for the use of a better term. It's the cheapest, safest, and easiest source of financing for any business as it goes about its growth story. But two is then raising capital from shareholders. And when you look at someone like Inghams, they've got a very proud history of keeping the amount of shares they have on issue relatively flat. In fact, there's been no change to it over the last 5 years, and that's a big plus in our view. But that then means that they're possibly considering the third evil, as it were, in regards to raising capital, and that is debt. And ultimately, when you raise capital via the debt market, it's cheaper than equity. Don't get me wrong, right? So, obviously, no one's going to send you a broker as an equity investor. Well, they can, but anyway, that's a story for another day. But in regards to debt, if you don't pay the ferryman on time, you don't get to the other side, as it were. So ultimately, the increased commitment in regards to that is something that's pretty important. The net debt position for the company currently sits at around $1.6 billion, which is not ideal. And unfortunately, it does, from an Altman Z-score perspective, for those that follow the good old professor, doesn't have them looking all that healthy. But for those that understand, I suppose, the underlying demands of a business, or the demands on a business like Inghams, then that is something you can dissuade, because you can go, well, look, volumes are still quite strong. You look at the recent reports in recent times, it shows that profits growing strongly. EBITDA is also growing quite consistently. And obviously the fact that they were able to increase their dividend also suggests that their cash flow is strong, which again, the numbers in Stockopedia also support as well. But net debt is that issue, part because of the asset purchases they're making, and also part because, quite frankly, it was a private equity vehicle. But don't worry, folks, the company's very well aware of this, and it's working as hard as it can, I dare suggest, in order to reduce that balance, that net debt position, as quick as it can to a more palatable level that'll keep investors a little happier.
Because listeners do need to be aware of course, that in the case of any wind-up of a company, that debt holders rank ahead of shareholders in getting their funds back.
Correct. That's right. That's the part I didn't mention in regards to the order of priority. And yeah, you don't often want to hear it as a share investor, but that's true. We are bottom of the rung. So if a company goes broke, unfortunately, that script's not even good enough for toilet paper, which in Victoria, admittedly, does carry a premium, but nonetheless is effectively worthless. And that's just not a position we want to be.
So let's look at the outlook. What can you see in the future, putting on your binoculars?
Look, I mean, it's obviously hard to necessarily suggest anything, but this outbreak in Meredith, whereby that egg tray had that H7N7 strain, I dare suggest will be contained. I don't suspect that will impact the business. So therefore, any irrational selling in a business like this, we feel does create an opportunity. And I mean, after the half-year results, the company rates 96 overall from a stock rank perspective, to be expected, given the fact that those underlying driving factors, again, as it were, and supported at that half-year report that those volumes are increasing and all that. So this is just what you want to see from a business like this. Chicken prices going up. So the standout's obviously the quality in regards to this business. I mean, we're talking about a return on equity of, some 50-odd%. It's growing its margins. The Piotrowski F-score is actually quite solid as well. And you've seen a range of analyst upgrades in recent times as well, and which is pleasing because they had been downgrading. So there would be, I'm sure, many people that have longingly looked at the momentum of the stock. In reality, it hasn't been all that great. I mean, it scores 77 at the moment, which means that it's not necessarily top of the tree in terms of heading in a direction northeast for a consistent amount of time, but it's not disastrous either. So it's at least been holding its own, with the exception of the other day, of course, where it fell 16% intraday. But of course, like I said, it did make up a lot of those losses when everyone sort of got real about it. And then when you look at value, I mean, this is actually not that bad. I mean, when I see a stock that trades on an EV to EBITDA of 6, I see it on forecast P of 11, as I talked about, I do get interested. Further to that, the dividend yield is currently 6.2%. All those earnings generated in Australia, so that'll be fully franked. And therefore, investors need to be cognizant that not only does it offer that potential for capital growth, but it does have the dividend as well. And generally, you find that if you find the companies that made the grade on 2, like as in increase their dividend over time, increase the size of their business, you get that quality compounding impact that so many of us want as investors, and hence why Ingham comes onto the radar. And yeah, in regards to its, I suppose, the story, as it were, while we know Australians' demand for poultry has been increasing, it's relative against all other meats. Its cost is still somewhat manageable. Most people, be it either in the frozen food section or in the fresh section or wherever it is, generally reach for the chicken because it is a reasonably affordable source of protein. Therefore, in a cost of living crisis that we're experiencing in Australia at the moment, there's going to be a strong underlying demand for the actual commodity itself. And therefore, we remain quite comfortable in regards to its outlook. I talked about the pain of the past. That would be an issue and concern for someone if you had been in the business back then. But I mean, in regards to the coming period, we think a lot of that is behind them. And therefore, they can focus more on their consumers and market conditions and all that sort of thing, which, again, do remain challenging. You can't ignore that. But really, the focus on automation, the removing of skeletons in the closet, all those sorts of things really help a business like Ingham. But if you turn a blind eye to the risks, you're kidding yourself, because at the end of the day, they're in the agricultural space. And Phil, I don't need to tell you, because I'm sure you've been an investor long enough to know that there are risks that investors need to be aware of.
Including vegetarianism.
Yeah,
Which you mentioned before.
Yeah,
but yeah,
correct.
those risks, it might be worthwhile just chatting just briefly before we finish up again about those risks. There's the vegetarianism, there's biosecurity, the cost of inputs on the business, and
Yeah, very
of
much
course,
so.
natural disasters.
Yeah, that's correct. And let's not forget, concerns over animal welfare and treatment. I mean, if the vocal environmentalist, as it were, gets particularly upset in regards to one of the broiler farms that they operate. And folks, it's important for me to remind everyone when I talk about broiler farms, what I'm saying is they're a part of the supply chain, as it were, but they're not necessarily owned by the business. Okay. So they're run by a third party, as it were. So it's almost effectively like a bit of a co-op, as it were. So all those issues impact. There's also, I mean, let's face it, there's very strong government protections in regards to our borders, in regards to poultry. I talked about that just a little earlier. If you're eating chicken here in Australia, you're just not going to find chicken that is grown or poultry that is produced in China, for example, because our quarantine and our government restrictions ensure that just doesn't happen. Now, I can never say never when it comes to investing, but if that position changes anytime soon, then that may very well impact the business model of an ING. And yeah, you talked about bird flu, and I don't think I need to do anything else but just point to the share price to show you how jittery everyone is in regards to this. When conditions are great, everyone will assess this as a regular ongoing business. But when things get tough and things get bad, they absolutely discount it for the fact that it is an agricultural business. So you do ignore those at your own peril. And it's probably one of the reasons why, to be frank, Ingham should be double where it is now. But the reality is it's not. And that's because there are these real active risks that investors do need to be cognizant of and do need to be aware of. And notwithstanding that this most recent outbreak appears contained and not in its relevant or not in a relevant region, it's something to be aware of. And just a timely reminder to everyone that, yeah, you're going to dance with the devil. Sometimes you got to get your fingers singed.
Elio D'Amato, a lovely analogy to finish with. Thank you very much.
Thank you very much, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.